the major topic, I hope you've been able to write it there under financing decisions. We have what we call the cost of what here? Cost of capital, where we have said you have got 3 sources of finances. I hope you have taken your notes down. And then this afternoon, I would want us to start by looking at how to compute cost of what here? Equity. So mention there cost of equity. 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 Now, ladies and gentlemen, the first thing that I would want you to do for me there is to write for Mwalimu the formula of getting cost of equity. If you're quite accustomed with our provincial officer formula, that provincial officer formula is very important. From this provincial officer formula, I'll be able to get, ladies and gentlemen, the formula of cost of equity very easily. Cost of equity is Kenya. Is there someone who has been able to write a formula there? Just be creative. I know at times getting those symbols there is not quite easy, but I like how fast my students are able to move. Really means using some fast symbols. Instead of saying over, you can even say divide by. It doesn't matter. Doesn't matter. Doesn't matter. What do we have there? They having
4 p.m. section 6.
Or there is a class at 4 p.m. section 6. I'll have to recover by 30 minutes or so. We shall overcome. We shall overcome. After all that, people of section 6 may not be as tough as FM. FM is the toughest paper. So you can forget that 30 minutes, you stick on here. FM is the toughest paper. I know of people who clear CPA section 6K, but they are left with only one paper. And if you ask them which paper is that, they'll tell you it's FM. Very good. So I'm waiting for the formula. Somebody has already given me a formula there. Yes. What are they saying? So KE equals district officer who wants to grow in ranks like that. All over, ladies and gentlemen, PO minus any cost of rotation that has been given. Very many of my students will always write this formula this nicely, but they will forget that our district officer normally grows how many times? Twice. The growth rate must be 2. Cost of equity is normally written like that. Where KE stands for cost of equity. KE stands for cost of equity. DO stands for current. O means today. O means today. So DO means current dividends per share. Please write in full. Current dividends per share. Current dividends per share. And then we have PO. PO is the current market price per share. Current market price per share. Current because of 0. And then we have got F. F, ladies and gentlemen, stands for what here? Flotation cost. Flotation cost. F stands for flotation cost. And then we have got G. G stands for growth rate. If you've discovered, I've decided to start this particular topic from a very low level. And then I should be able to build up to your level in the next 20 minutes. But I've just decided to start it from scratch because I know the sensitivity of this particular topic. And so many students have realized if I start it up there, they always get confused. So G is the growth rate. So on that handout, I want us to go to that particular handout, example 1. We look at the examples given there. We look at the examples given there. This is a handout example number 1. This is a handout example number 1. I hope everybody has that handout, including our brothers and sisters from Summit. Including our brothers and sisters from Summit. So this is a handout. Here, section 3, FM. But I know the sensitivity of this topic, so I want to put a very good foundation. Very good foundation. So if you go to page number 2, you'll be able to see example 1. Are you there? Page number 2, example 1. I hope everybody has this handout. Page number 2, example 1. Page number 2, example 1. Page number 2, example 1. What are they saying? WhatsApp, which group? Someone talk to me. Which group is that? Which has not received this handout? Because I was already sent separately. For the Summit students have to talk to The lady who normally does that for me. It's already there. Oh, okay. Okay, so here we are. So number one, what we have there. So number one, ladies and gentlemen, we are told page number 2. S Limited, quite a simple example, has in issue shillings 1 shares with a market value of shillings 2.4. So the market value is 2.4. The current market value is 2.4. A constant dividend of shillings 0.3 per share has just been paid. And then they want us to give them the cost of equity to the company. So the cost of this equity to the company okay. Leo ni siku yetu, kila siku ni siku mzuri. Kila siku ni siku mzuri. Hakuna siku kitu mbaya. Everything happens for a reason, eh? After your point in wanafunza, maybe hata ungeshika vile akabreak ni necessary, you never know. Everything happens for a reason and for the better. So here we are, ladies and gentlemen. Here we are, ladies and gentlemen. So we are told here the DO. DO means dividend already paid. They are telling us, ladies and gentlemen, a constant dividend of shilling 0.3 per share has just been paid. So we have here DO. DO is 0.1 here, 0.3. And the current market price per share is 2.4. They have not mentioned anything to do with growth rate. Nothing to do with growth rate, and then they want us to give them nothing to do with the flotation cost. Flotation cost is 0. So they want us to come and give them the cost of what here? The cost of equity. So the cost of equity will be equal to DO, the DO, return itself, which will be 0.3 into 1 plus D, which is 0, all over PO. PO, which happens to be 2.4, of course, minus nothing for flotation, plus the growth rate at the end of the day is 0. So here you have to move slowly and they give us the numerator, denominator, divide, whatever you get plus 0, whatever you'll be having will be the cost of equity. Please give me an answer. What is the cost of equity? What is the cost of equity? .5%, that is correct. We go to the next question, that is example 2. Example 2, still on page number 2. Example 2, we are told A Limited has in issue Kenya shilling 0.5 million. Kenya shilling 0.5 million shares with a market value of 4.2. So this time around, our market value per share is 4.2. So our PO is 4.2. A dividend of 0.4 per share has just been paid. So our DO is 0.4. And this time around, dividends are growing at what rate here? At 6% per annum. Dividends are growing at 6% per annum. Required, what is the cost of what here? Equity. What is the cost of equity? Quite easy. Ladies and gentlemen, these people have given us our DO. So our DO, what do we have there for our DO? They have told us that our DO is dividend which has just been paid is 0.4. And then we have our PO. Our PO, ladies and gentlemen, happens to be what here? 4.2. 4.2. Ladies and gentlemen, these guys have given us the growth rate. The growth rate, they're telling us 6%. 6% is the same as 0.06. 6% is the same as 0.6. So come and plug the figures in here and they give us our DO, our KEME. So our KE here will be equal to our DO, which is 0.4 into 1.06. 1.06 limit our is up here 1 plus growth rate, 1 plus 6%, 1 plus 0.06. All over PO which is 4.2, we don't need any money to float our shares. Nothing for marketing our shares. So the flotation cost there is 0 plus an independent growth rate, which is 0.06, plus an independent growth rate, which is 0.06. 0.06. So you can give us an answer. You have to be careful here. So you're talking of 0.4 times 1.06 divided by 4.2 plus 0.06. Please give us an answer here. I'm being given by Francisca 16.1. 16.1%. Thank you and thank you very much. Thank you and thank you very much. And I hope it's everyone who is getting this figure. I hope it's everyone who is getting this figure. I hope it's everyone getting this figure. Now we go to the next question, ladies and gentlemen. If dividend has just been paid, then it is at no. D1, remember, we're coming to that. D1, my brother, is expected dividend. Dividend that is yet to be paid. Because when 1 means what? 1 means at the end of year 1. So you have got D0. D0 is about today, has just been paid today. It's historical. So D1 means expected at the end of year 1. I hope I've answered you. I hope I've answered you, or if there is any comment you want to make about that. So we go to, very interesting stuff, ladies and gentlemen. Very interesting stuff, ladies and gentlemen. If you look at example 4, example 4 is all about a situation where you are not given, we are not given, if I skipped any, or even the one I've skipped is quite similar to what we've done. Example 4 is about a situation where you are not given growth rate. The growth rate is not given. In most cases, if you look at your past papers, your growth rate is never given. So if growth rate is not given, no growth rate. No growth rate. If growth rate of dividends, no growth rate of dividends. If growth rate of dividends is not given, there are 2 ways that we could use to get this growth rate. 2 ways we could use to get the growth rate. One of the ways, I want to believe you still, guys, you still remember this, that our G will be equal to n minus 1 into, we have the current DPS, all over the oldest DPS. And then at the end of the day, we'll come and subtract what here, we'll come and subtract 1 there. At the end of the day, we'll come and subtract 1. Remember, N stands for number of years. N stands for number of years. N stands for number of years. Number of years. So N minus 1 into root over current dividends, all over oldest dividends, minus 1. So ladies and gentlemen, I would want you to do me a favor even before I show you how to get this G. If somebody wanted to get the 5th root of 10, the 5th root, or the 5th root of 9, could you kindly give me the answer? 5th root of 9. Let's see how many students will be able to give us the correct answer, that is 15. 5th root of 9. The correct answer is 15. The correct answer is 15. 5th root. 5th root. Well, we have this, even this 5, like that. The 5th root of 9. The correct answer is 15. Let's see how many students will be able to get 15. The correct answer. The correct answer. 15 and 1.5. So, how many of us are saying it's 1.55? How many of us are saying it's 1.55? Now, for the many years that I've marked CASNEB exams, I've never understood, na sikupenda kwa wanafunzi. Utapata mwanafunzi anakuambia mwalimu, ati ni sawa na kusema 5 times square root of 9. Anakuambia mwalimu ni sawa na kusema 5 times 3 now. That's how they are able to get what here 15. Ladies and gentlemen, 5th root is something that is very different. If you go to your calculator, you'll be able to see a button there that has got this bullet raised. If you go to your calculator, you'll be able to see that bullet. And on top of this bullet, you'll be able to see something else which is funny, which is called extrude. Extrude. So please try to identify this extrude. And if you have identified it very well, you'll be able to see that this extrude has been written in that color that Mwalimu loves so much. The yellow color. So this color yellow is the color of what here? Shift. So meaning, ladies and gentlemen, that at the end of the day, if I would want to get extrude, the first thing that I will do is to press the 5, and then I say shift. I press that button. So 5 shift, I press this button. So 5 shift, I press this button. Right? Once I do that, I will see there 5th extrude. And then I'll be able to press 9 there. 5th extrude of 9. And then I say equals. 5th extrude of 9. And then I say equals. 5th extrude. And then I say equals very fast. You'll be able to see most students are getting 1.what here? 1.55. What I intended to do here. Another 15. I hope now you've been able to see where the extrude is. Or even if it's an 8 2, isn't it? Even if it's an 8 2, it works perfectly well. I know what that student means. Even if it's an 8 2, it is working perfectly well. Thank you very much. Now, ladies and gentlemen, listen and listen. So the correct answer is 1.55, isn't it? 1.55 is the correct answer. So could you kindly try out this? Let's try out this. The 4th root of 99. Give me the answer. The 4th root of 99. 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 I can now see most of them are really pulling up the figures. They're saying it's 3. 3.15. Thank you and thank you very much. Thank you and thank you very much. Now please look at example 4. So example 4, what do we have there? Example 4. Example 4, it is now, whatever year there, has Y Limited has paid out the following total dividends in past years. So you can see 06 all the way to 2010. I can see my total dividends there. They are growing. So what do they want me to do? They want me to estimate the average rate of growth in dividends per what year? Per annum. The average growth of dividends per annum. This is the formula that I will use for example 4. This is the formula that I will use for example 4, ladies and gentlemen. So what I will do, I will come here and plug in because we already have the formula. Number of years in the case of 1, 2, 3, 4, 5. So I'll talk of 5 minus 1. Rule, not square, but rule. The current dividends that I'm able to see because I don't have number of ordinary shares, I work with total dividends. The current one, the current is 2010. So it will be 33,000. 33,000. All over 28,000. And then at the end of the day, minus what here? Minus 1. So in short, this will be the fourth root of who can give me this in terms of managers and like 33,000 divided by 28,000. Somebody give me this answer. Somebody give me this answer. Why less 1? Why less 1? It's because, ladies and gentlemen, you see we have 2006, 2007, 2008, we have 2009, we have 2010. You see, they want the difference in terms of timing from here to here. So in short, if you don't want to be less in that 9, be counting these with 1, 2, 3, 4. You can count it like that. Right? But the very best is simply to pick the number of years that you have, 1, 2, 3, 4, 5. The mathematics of posts and the spaces. Take posts, less 1. So what figure are they able to give me here? Somebody is divided by this 1 point? 17? 86, ladies and gentlemen. And then now listen to me very well. You know, this thing is normally independent. So first of all, chapa fourth root of this figure. Fourth root of this figure. Chapa the fourth root of this figure. Before the percentage, are they able to get the fourth root of this?
What is inside should be 4.1.
Oh, what is inside should be 4.19. It can't be 4 because you see 38,000 divided by 28,000, my friends. 33,000 divided by 28,000 cannot be 4. Cannot be 4. Somebody give me this 33,000 divided by 28,000 is what here, somebody? 1.04. Thank you and thank you very much. Now we want to see whether we have got someone here who will be able to give us the fourth root, that thing of x root, that thing of raised. So 4x root, rest this. And then whatever answer you get, don't forget to deduct 1. Whatever answer you get, don't forget to deduct 1. Whatever answer you get, don't forget to deduct 1. So then what do we have here at the end of the day? Somebody give us an answer.
15.6.
15.6%. I don't know how they are able to get this parameter. Let me just use my calculator.
4.2%.
No, let me just use my calculator. So we are saying here, this will be the fourth root of 3,000. So we have here 3,000. So we have here 33,000 divided by 28,000 equals. So here I should be talking of 1.1786 like that. And then on the fourth root of this figure, whatever I will get there, I'll come and subtract 1. So give me the fourth root of this figure, and then whatever I get, I subtract 1. So could you kindly give me the final answer here? Kindly give me the final answer. 4.19%. Is it coming from many students? 4.19, I can see 4.19%. Thank you and thank you very much. Thank you and thank you very much. That is example one. Now, ladies and gentlemen, on that breath, on this breath, you will get this kind of a situation where the examiner, ladies and gentlemen, you have here DPS. So we have 10, 8, 7, 1. So we have time here, we have 2012, 2011, 2010, and 2009. So on the examiner, this is 10,876. The examiner will come and tell you, you determine the growth rate of dividends. Let me give you 1 minute to try out that. Very good. So 18.6 is what you're getting. 18.6 is what they're getting. Because they have remembered the formula very well, that our G should be equal to n minus 1 into, we have here the current what here, dividends per share, all over the oldest dividends per share minus 1. So n number of years is 4. So 4 minus 1, that gives me cube root, third root. Current dividend is not this one. The most current year is 2012. So you're talking of 10 over 6 like that. 10 over 6. And then whatever we shall get here will come and subtract 1. So this will be the third root of 10 divided by 6. So 10 divided by 6, what do we have here? Come and tell us. 10 divided by 6, what do we have here? So you come here and tell us 10 divided by 6. So we have here 10 divided by 6, which at the end of the day will give us 1.667 what here? 7. So we have here 1.6667 like that. So whatever we get, don't forget to subtract 1. That is how those students, after they got some figure and multiplied it with 100 for purpose of changing it to a percentage, they got 18 point what here? 6%. 18.6% is correct. Is correct. Illustration, ladies and gentlemen. Illustration. We have what we call return on assets. Return on assets is 12%. Return on assets is 12%. And ladies and gentlemen, they have given us the retention ratio. The retention ratio is 0.5. Retention ratio is 0.5. And ladies and gentlemen, these guys have given us what we call DO. The DO is 3. Then they have given us PO, which happens to be 11. Then they have given us quotation cost, which happens to be 1.2. And then they want us, ladies and gentlemen, to determine cost of equity. They want us to determine cost of equity. ROA. ROA stands for what here? Return on assets. We have retention ratio. We have DO. We have PO. We have the flotation cost of 1.2. We have here the requirement KE. The only thing that I will be able to do for you is to remind you the formula of getting this most beautiful country in the world called Kenya, KE. To get KE, we normally talk of PO into 1 plus G all over PO minus any flotation cost plus, ladies and gentlemen, G plus G plus G plus G. But now you see G has not been given. And I'm not going to give it to you. I would want to see whether there is anybody who can make, in this case, here some reason there. Yeah, some reasoning to give us the value of G. Let's see. Now, ladies and gentlemen, let's see what they have. Let's see what they have in this question. Let's see what they have in this question. Let's see what they have in this question. So here, the most important thing that my students were able to understand very well is that there are two formulas of getting the growth rate. There are two formulas of getting the growth rate. There is this formula of getting the growth rate, which you normally call BR, which you normally call BR. And ladies and gentlemen, for us to be able to get this BR, we have to know what B stands for and what R stands for. So don't forget that B is the retention. B is the retention. So B, this is the retention ratio. This is the retention ratio. And then R is our return on assets. R is our return on what? On assets. R is our return on assets. R is our return on assets. So in short, I would want you to understand this very well. Even at your personal level, you should endeavor to retain most of the income you get through savings, of course. So you get, like, for example, 100,000, try to squeeze your budget to be catered for. Your budget in this case here should be fully financed, perhaps by 50% of your gross salary or of your net salary, right? So you go for the forced savings, where the employer deducts and remits to Mwasibu Sacco, remits to these other serious circles like that, or to insurance companies, if you like insurance products, etc. So the more you retain, and whatever you have retained, don't go and hide it somewhere in another trace. You're investing the same, in this case here, in assets which are able to give great returns on assets. So automatically, if you are retaining and saving on assets that have got high returns, automatically as an individual or as a corporate, you will grow. You will grow. So growth rate is a function of how much do we retain, what return are we getting out of assets that we've been able to invest in. So our G equals who? Equals BR. Our G, ladies and gentlemen, equals BR. So our G will be equal to B. B is a retention, which is 0.5, and our R is this 12%. So basically our G will be 6%. This is the same as 0.06 like that. Now, having gotten that, getting my PO is a walk in the park. Check the question. Yes. Ile one. Okay, so I'll be able to answer. I know what the student is asking. Ladies and gentlemen, here we are. We have our growth rate. So once I have my growth rate like that, then I'll be able to plug in now the figures. So the DO is 3. We have into brackets here 1 plus the growth rate. And the growth rate happens to be 0.06 like that. The growth rate happens to be 0.06, right? All over PO. PO, ladies and gentlemen, which is what here, 11. But now remember, this time around, we are not very fortunate. For us to be able to sell our shares, we must float them up at a cost of 1.2 per share. A cost of 1.2 per share. Plus, ladies and gentlemen, the growth rate again, this growth rate is 0.what here? 0.06 like that. 0.06. 0.06. So if you move slowly, you'll talk of 3 times 1.06 divided by 9 point something, isn't it? Whatever we get plus 0.06. Yes, which gives us 33.what here? 38.44. Is there anyone who was able to get this correctly? 4544, the same percent, isn't it? Percent. Now, ladies and gentlemen, for me to be able to answer that student, remember just the other day, the price of unga was about 100 Kenya shillings per packet of 2 kgs packet. So this price of unga maybe last year. And then this year, the price in this case here goes to 100 what year? 20. So they want you to give them the growth in a price. The growth in price. You can give me this answer. The growth in price of unga. The growth in the price of unga. Last year it was 100. This year it is 120. So in this case here I can see growth there. Please give me the answer. %. Thank you very much, 20%. But I know you have used the old method there, which is equally good. But a good student will tell you to be able to get the growth in price, come and take in this case here the current price, which is what here 120. All over the oldest price, which is 100. If you do this, you'll be able to get the compound thing. But of course, if you are only interested in the growth, you will come and subtract 1. So if you do that, you'll be able to see the final answer being 1.2 minus 1 is 0.2, which is the same as what here? 20%. So the same case with our growth rate of dividends. Take the current dividend divided by the oldest dividend. Only that this time around, we must talk of the nth root. But we have to deduct 1 at the end. If you don't deduct that 1, you end up getting an answer which is more than 100%. Very good. Let's go to example number 5. on this handout of ours, example number 5. Example number 5. Example number 5. So example number 5, we are told that Y Limited retains 40% each year and it's able to reinvest so as to earn a return of 20% per annum. What is the expected growth rate in dividends? I know that one just by opening your eyes like this, you can even see the answer. With myself, I've seen the answer. That's a useless question. To us right now, this concept of PR, where we take the retention multiplied by the return, percentage returns is quite an easy one. So that takes us, is there somebody who has been able to see the answer? 8%, yes, 8%. Now that takes me to example number 6. Example number 6, now that is yours, that I expect you guys to take like 2 minutes to give me the answer. 2 minutes. So what answers are they getting for us? But the students who have given me the answers, they are very few, very few. They're very few, very few, very few. So, ladies and gentlemen, we are told Z Limited has in issue shillings 1 shares with a market value of 2.8 per share. A dividend of shilling 0.2 per share has just been paid. Earnings per share were shillings what here? 0.32. The company is able to invest so as to earn a return of 18%. Here the key thing is that I have to know how to calculate the dividend. I must know how to calculate the dividend payout ratio. The dividend payout ratio. So dividend payout ratio, ladies and gentlemen, here will be equal to dividends per share all over earnings per share. What we earn out of whatever we earn, what are we able to pay? So I'll take dividends per share all over earnings per what year? Per share. So ladies and gentlemen, in this particular question here, we can see that the dividends, what we have there in example 6. The dividends which were paid were 0.2. So 0.2 all over the total earnings, in this case here, which are 0.32. So will you give me this in form of decimal? Somebody help me out. 0.2 divided by 0.32 will give me what figure, somebody? 0.625, isn't it? Now the moment I have 0.625 as the dividend payout ratio, then I'll be able to know the retention ratio. So the retention ratio will be equal to 1 minus the dividend payout ratio, which is 0.625. So what we are able to retain will be, of course, 1 minus what we pay. Yeah. So you kindly give me the retention ratio here, which will be 1 minus 0.625. Please give us an answer. Give us an answer. 0.375. Thank you, and thank you very much. Ladies and gentlemen, having gotten this, of course, I appreciate the fact that this is my P. So I only need the R, the concept of the returns. I only need the concept of the returns. So for the concept of the returns, what do I have here for the concept of the returns, ladies and gentlemen? Returns, we are told. Returns, we are told. The company is able to invest so as to earn a return of 18% per annum. Now, once you give me the 2, then I'll be able to give you the G. I know G is PR. So B is 0.375 multiplied by 0.18. So go ahead and give us an answer. So 0.375 times 0.18. Please go ahead and give us an answer.
6.7%.
6 point?
7.
Just that or
75%.
6.75%. Now, ladies and gentlemen, the moment I have these as my retention ratio, then I think now everything else boils down to our calculations. Everything boils down to our calculations here. Now come and straight away, ladies and gentlemen, straight away, but they want us to give them, estimate the rate of growth in dividends. That we have done very well. Now go to B, where they want us to estimate the cost of equity. So B, cost of equity B, that is as easy as a leisure walk in the park. So to get cost of equity, ladies and gentlemen, what we have here, we have DO into 1 plus G all over PO minus flotation. At the end of the day, plus what here plus G. So we have our cost of equity being equal to DO. The DO, ladies and gentlemen, that we have, which has been given. DO that we have here, that has been given, the DO, market value is 2.8, dividend is 0.2. So 0.2 into 1 plus 6.75%. All over PO, which is 2.8. There's nothing like flotation in this question. Ladies and gentlemen, plus our growth rate. Our growth rate is this 6.7, which is the same as 0.0675. So could you kindly give us an answer at the end of the day? What do we have here? 14.38. Is there anybody who got this answer much earlier? Will you give them the questions to do? Thank you. Now from there, lastly, they want us to give them the market value per share in 2 years' time. The market value per share in 2 years' time. So remember, this is just synonymous to using the compounding formula, where amount will be equal to principal into 1 plus R raised to power n, where this amount will be MPS at the end of year 2. The principal will be the MPS at time 0. 1 plus, remember R is the cost of capital. The cost of capital is supposed to be 14.38%. R is the cost of capital raised to power what here? Power n. So the current PO is 2.8. The current PO is 2.8 into 1 plus 0.1 raised to power 2 like that. Here, I'm so sure so many students will use the growth rate that they got there. But remember that growth rate is growth rate of dividends. It's a growth rate of, if they asked me the dividend in year whatever, I would have used that particular growth rate. But now here, we are talking about, ladies and gentlemen, MPS, market price per share, a component of equity holders. So equity holders, they'll expect, if, for example, they don't take up any of their dividends, their MPS should be growing like that. So could you kindly give me the final answer here? Can you give me your 3 points? And I'm so sure all of us would have gotten that entire question in our exams. I'm 100% sure of that. Hakuna hata mwanafunzi mmoja kati yenu ama kati yetu angelamba chini. Sisi wote tungepata hii kitu correct. Correct. So I want us to see how, ladies and gentlemen, this concept has been applied consistently in our past papers. How we apply this consistently in our past papers. So May 2019, question number 3B. May 2019, question number 3B. May 2019. Question number 3B. Question number 3B. If you look at the requirement, number 1, they want us to give them the firm's return on equity using Gordon's growth approximation method. Return on equity using Gordon's approximation method. So I know you may have done this question in class, but I would want us to put those class notes very far away. In your very honest way of doing things, ladies and gentlemen, could you kindly give us the growth rate? Give us the growth rate in this particular, or rather the rule in this particular question. Give me the rule, the return on equity in this question. Any question there? Which question is this? It's May 2019. May 2019, question number 3B. May 2019, question number 3 board. May 2019, question number 3 board. For those of you who have got these revision kits, it's page number 91. Page number 91. Page number 91 is a question there called Zomolo. Let's see how this concept that I've taught you. Share the screen. Unfortunately, we can't do that because I don't have this in soft copy. But someone should be able to share with you this question in the WhatsApp by basically taking a screenshot of this question, sharing it. I'm so sure someone will be able to do that right away. We are not correct. No, there is a student there who got it correct. Remember, they don't want us to get just return on equity. No. They don't want us just to get G. They want us to get return on equity using Gordon's growth approximation method. So Gordon's growth approximation method, remember Gordon spoke about ascertainment of the growth in dividends. Gordon has done quite a lot of work in finance. So here he came and spoke about the growth rate. So the first thing that I'll do is to come and give my examiner the growth rate, which will be n-1 root of current DPS all over the oldest DPS minus 1. So this n, they have given us a series of various what here? Dividends over, I think 3 or 4 years. 4 years there. So I can see number of years are for 2018, 2015. So we have 2018, 2015, we have got 4 years. So 4 minus 1 into current dividends per share. Current dividends per share, what do we have there? 4.8. So we have here 4.8 all over oldest dividends per share. Oldest dividends per share, we have 4 minus 1. So then this will be cube root of, what is 4.8 divided by 4? That must be 1.2. So 1.2. So cube root of 1.2. Cube root of 1.2. Cube root of 1.2. What do we have there? Cube root of 1.2. Whatever we get, we subtract 1. Whatever we get, we subtract 1. Please guide us accordingly. What do we have there? Guide us accordingly. What do we have there? So at the end of the day, when you subtract 1, what is the growth rate? 6.27%. 6.27%. Thank you and thank you very much. But you see, after getting that particular growth rate, ladies and gentlemen, that is not yet enough. You have not arrived at in Canaan. You haven't. Why? Because the examiner is talking about a connection between your growth rate and return on investment. And the only connection that we know between the two is the one that tells us that G equals BR. And unfortunately, this examiner has given us the dividend payout ratio. The examiner has told us to give them the dividend payout ratio. Dividend payout ratio amesema ni 60%. Hapo Amesema ni 60%. Which question is this? I can't get what he's asking. The question, ladies and gentlemen, is May. How come the colleagues are not willing to tell this student? May 2019, question 2. No. It's May 2019, question 3B. May 2019, question number 3B. May 2019, question number 3B. Right? And look at the sensitivity of this topic that we're doing today. If you look at that particular sitting, if you look at, for example, May 2019, question 2, still was a question on financing decision. If you look at the same sitting still, May 2019, question 1, it was an advanced financing decision. And the examiner makes it crazy hard when he brings it. Of course, they're not hard. These are just conceptual things. When he brings these things of Morgan Miller, it is, or even worse still, when he gives us bond refinancing. But here we are. There's somebody still who are sleeping, Joki is still asleep, perhaps he's trying to understand question very well. At times, my friend, silence is very good at times. It works. But also if she has a problem, I'm so sure Joki is in the mother's and you get out. So they've given us the dividend payout ratio, which is 60. So if we are paying 60%, we are retaining 40%. So then the retention ratio is 40%. The retention ratio is 40%, which is the same as 0.4. Now, ladies and gentlemen, the moment I have this, now I'll be able to go back to my formula. We are saying that G equals B times what here? Times R. G equals B times R. So we have our growth rate. The growth rate is the one that you guys gave me a figure of 6.27%. Equals B of 0.4 times this R, which basically is our return. Could be return on assets in most cases, or return on equity. So please make return the subject of the formula. If you make return the subject of the formula, so our return here will be equal to 6.27% divided by 0.4. So you can give us an answer. What is 6.27 divided by 0.4? Give us an answer. So the return here will be again 15.67%. So 15.67%. I'm so sure all of us would have gotten this in an exam. I'm 100% sure. There's not a single student angeanguka question. Hakuna. Kuna mwingine anasema Modigliani Miller, it's the easiest. Next week we'll be doing this Modigliani Miller things. That is the easiest stuff. So long as we share doing formula provincial officer, we always push on IFM. We do everything, in this case, almost everything in this financing in revolve around provincial officer. Was a key player in finance. Now, ladies and gentlemen, we go to the second part. So the second part they want us to do, how can they ask us about something this easy? In this particular section 5, section 5 is supposed to be a serious section. We expect serious questions. How do you ask us about WACC? So WACC, ladies and gentlemen, I know how to get WACC. Like in this case, it will be weight of equity, cost of equity. It will be weight of equity, cost of equity, plus weight of preference, cost of preference, plus weight of debt, cost of debt. But remember, cost of debt, unlike the others, cost of debt has to be tax deducted. Because debt, we normally pay interest. And for debt, ladies and gentlemen, that interest is tax allowable. So then the first thing I know sitakuwa na shida na weights. Mali kuna taabu, muadhara, the cost of equity. But I know my students can't be defeated with this easily. Cost of equity. Could you kindly give me the cost of equity? Kindly give me the cost of equity. What do we have there? Somebody, cost of equity. These are the questions. Why are we not using? Or in this question. So no problem. You just come and use here 0.0627. You divide by 0.4. And then at the end of the day, whatever you get, to convert it to percentage, multiply with 100. You'll still end up getting the same answer. You still end up getting the same answer. There's even a student who had tried answering that student on my behalf. Thank you and thank you very much. We need to be sharing this lecture fees with those students who normally go out of their way to help me. But of course, as you know, teachers were never paid. They're just like priests, just here to serve. Service. Okay. So cost of equity, you're getting cost of equity, we are getting cost of equity. I'm so sure there are those students who are very much tired. Cost of equity is not a problem, so long as I remember my district officer. So long as I remember my district officer, then my cost of equity will be equal to district officer into 1 plus what here, G, all over provincial officer whom we must deduct something from because it's a senior person. So minus the rotation cost plus the growth rate. So ladies and gentlemen, please go ahead and substitute for us, give us the cost of equity. Is there somebody who is able to see DO anywhere? DO anywhere there? Yes, I am able to see DO. DO is the most current dividend. They have given me 4 of them. And the most current dividend, ladies and gentlemen, is the one given in note 4. The one given in note 4, ladies and gentlemen, the most current dividend of 2018 is 4.8. 4.8 into 1 plus. Is there somebody who is able to see the growth rate of dividends? Thank you very much. How about the growth rate? Growth rate of dividends. Please give me an answer. How about the growth rate of dividends? Growth rate of dividends. What do we have here? Growth rate of dividends. What do we have here? Somebody over here. Growth rate of dividends. What we have to call you? Patapotea. Growth rate of dividends. What do we have? Somebody. 6.27. Thank you very much. So plus 0.0627 all over PO. PO, ladies and gentlemen, the PO, ambao unafaa kuwa nayo PO, the current market price per share. The current market price per share is 30. There's no flotation cost. The current market price per share is 30. The current market price per share is 30. Is there somebody who's able to see 30? Check there. No, it's not 34.8. That 34.8 is fictitious. They have told us that 34.8 is CAMDIV. CAMDIV. So this is MPS CAMDIV. So whenever you're given MPS CAMDIV, you'll have to subtract the current dividend. You'll have to subtract the current dividend to get MPS without any dividend. To get MPS without XD. To get MPS XD. In finance, we don't use the CAMDIV things. CAMDIV things, we don't use them. So you can see the MPS CAMDIV is 34.8 minus the current dividend per share is 4.3. That is how I was able to get my figure of 30. Now ask a question. Ask a question. Ask a question. Ask a question. Anytime you go to, for example, an exam, and you're told that this market price is CAM interest, you must always subtract the most current interest. Yes, sir. What is the meaning of CAM dividend? It means that the person who is going to buy this particular share at a particular price, like this 34.8, will be entitled to receive the next dividend. right, will be entitled to receive. So basically the share is coming with a dividend component. But now remember that dividend, honestly speaking, is not a dividend that you should claim as an investor. Why? Because you never worked for it at all. You only, in this case here, got a favor because you got an investor who, for example, was in a fix, for example, wanted to pay school fees for children. Now they can't leave a child at home. So this person came and told you, hata kama ng'ombe iko na mimba, nunua tu. Lakini ukijua very well kwamba you don't deserve this extra what you benefit. So it means that this dividend which is coming with this share distorts the market price. Look at, for example, Safaricom. When they want to issue dividends, normally because of the signaling effect, you then get the market price per share going up. And that is why for evaluation purposes, we don't take these things here with their benefits. No. We don't take them with their benefits. Assuming they don't have any benefit, X, what should be the normal price? X, what should be the normal price? So any other question there? We check DO. So why use current, which is 4.8 year 2018? Ask the lecturer to check DO again. So we check DO. So this DO is supposed to be what? Remember, DO is not supposed to be the oldest. You know, the students will tell you that this O stands for oldest. Now you use more there. No. DO stands for the most current dividend. And between these years given there, 2015 to 2018, which one honestly is the most current year? It is 2018. And what's its dividend? It's 4.8. So I'm waiting to still read your questions. This surprisingly happens to be my best class because of the engagement. So there are students who will never ask you any question. That engagement is so nice, also making me to think. So by the time I'm finishing a class, I also feel exhausted. Yeah, I also think so that I can learn. You look tired, sir. Sure, no. I'm just going slow so that you can understand these things. Thought, do was. No. DO is not the oldest. DO is the most current. O means what yet today. O means today. O means today. O means today. O. To the times 0 is today, not the oldest. Not the oldest. So are we together? Are we together up to there? DO. DC. But now you see, the people who discovered these models, Gordon and the rest, they decided to call it time. You know, it's time 0. The way you have it, time 0, 1, 2, 3, like that. So it is dividend at time 0. So dividend today, today's dividend. If you look at this particular question, ladies and gentlemen, they have given you many years. We have in this case here what we are calling the oldest year, and then we have the most current year. The most current year there is 2018. The most current there is 2018. Which? When do we use B1? Good questions. So first of all, let us finish this question. Please give me the growth rate. Give me plus the growth rate here. We finish this question first of all. So we have here plus 0.0627. 0.0627. Please give us an answer. Give us an answer. 32? 23.27%. That is the cost of equity. The cost of equity. The cost of equity. Thank you. Now we want us straight away to get some place where you can write some rough work. We can write some rough work because I want us to continue this question in our next class. We can write some rough work, ladies and gentlemen. We can write some rough work, ladies and gentlemen. We are given this question here. We are given DO is 5. We are given G is 10%. G is 10%. G is 10%. They have given us PO, which happens to be what here 20. And then they want us, ladies and gentlemen, they want us required to determine KE. Determine cost of equity. Determine cost of equity. Determine cost of equity. Determine cost of equity. Or you can write some rough work there. Determine cost of equity. Determine cost of equity. How do we get cost of equity? So cost of equity here will be quite an easy thing to get. To get cost of equity, I'll take DO into 1 plus G all over PO in this case plus G plus G plus G plus G. So my DO here is 5 into 1 plus G point 1 all over PO, which is 20 plus G which is 0.1. So could you kindly give me an answer? That's 7.5. Thank you and thank you very much. Now I want to explain something very nicely here. Ladies and gentlemen, when it comes in this case here to cost of equity or valuation of shares, we prefer always working with dividends that have not been paid. What we call futuristic dividends. And our futuristic dividend here, look at this. Look at this. You'll get some literature saying that the cost of equity equals what here? D1. D1. All over what here? Somebody PO plus what here? Plus G. So we look at, ladies and gentlemen, cost of equity will be equal to the dividend we are yet to receive, which will be receiving at the end of the year. At the end of the year. At the end of the expected dividend. Divided by our original investment. So, and it is this D1 that we normally get by taking DO into 1 plus what? Into 1 plus G, like that. And that is why I'm surprised that you guys would want to use the oldest dividend, and yet there are other dividends which have been paid, and yet knowing very well that in finance, we normally look what here forward for valuation or costing of sources of finance. We normally look at forward. We can only use the historical for purpose of getting what here? Growth rate. But otherwise, we normally look ahead. We normally look ahead. So please ask questions now. So I hope I've been able to tell you, like now, ladies and gentlemen, get a question like this. You get a question like this and exam. You get somebody telling you that the expected dividend is A. Then they will give you the current market price per share is 80. And then they'll go ahead and give you the growth rate, which is perhaps 10%. Perhaps 10%. So then they'll come and ask you to give us KE. Let me give you 1 minute. You give me KE as we break. Give me KE here as we break. Give me KE as we break. Give me KE as we break. Here, I'll come and write my cost of equity very well. Formula is DO into 1 plus G all over PO. After I do that, ladies and gentlemen, I'll come and say, and then I'll remember, this PO one, this examiner has used the language of expected dividend. So this is supposed to be D1, meaning that my KE is supposed to be D1 over PO plus G like that. So the D1 is 8. PO happens to be what here? 80. Plus the growth rate, which happens to be what here, somebody? 10%. 10% is the same as 0. So then could you kindly give me the final answer? It will be 8 over 10, that's 10% plus 10%. That gives me 20%. 20%. That gives us 20%. So ladies and gentlemen, if there is no question, please allow us to have this thing ending now. Your 40 minutes, I'll know what to do. I can even make a video and send it. I normally don't steal from my students. I normally endeavor to give more than I receive from my students. So it has been a pleasure hosting you this afternoon. And I want to imagine that even with my slow speed, you guys have been able to pick up something. God bless you. Have a lovely week ahead.